Okay, Walter Wofford back, short-term rental cash flow roadmap. We've got another step today, and this has to do with acquiring properties for short-term rentals. Now, you can go to the bank and borrow money, you can do a joint venture, you can negotiate seller financing, but here's another one that is very powerful, and it really is unlimited money out there for you for your short-term rentals. It's called buying a house subject to the mortgage. Now, there's an existing mortgage, let's say it's at 3%, that's got little equity. And you can go and buy that house subject to the mortgage, take over the payments, but not assumption of. Very powerful technique. So if you want to learn more about it, uh, we're going to get in the weeds again, but this is something you can do, and it solves a lot of problems for certain owners. Okay, so if you'd like a copy of this ebook, just pull out your camera, focus on the QR code, and hit the link. Fill in the information. It will send you the book immediately. As always, I've got my AI team, Bill and Judy, here helping me with this content delivery and preparation. I know you're going to enjoy it. Subject to.
Okay, let's unpack this. If you're looking at real estate investing right now, especially short-term rentals, you've probably felt the pinch. High interest rates, banks being cautious.
Yeah, needing those big down payments.
Exactly. It's tough sledding if your goal is to really scale up your portfolio.
It is. Traditional financing, well, it's definitely slowing a lot of investors down, especially if they want to expand their STR operations.
Right. And you've brought some material today that digs into a really interesting kind of creative way, maybe get around some of those roadblocks. We're talking about buying property subject to the existing mortgage.
That's right. It's a strategy that, when it's done correctly, it can let you bypass those traditional lending hurdles almost entirely.
Oh, okay. So in this deep dive, our mission is to get a clear picture, based on this material, of what subject to actually means. How does it work, like step by step? Who is this strategy really good for, especially in the STR world? And crucially, what are the benefits and the risks? The things you absolutely need to be aware of.
Yeah, prepare for some insights, maybe. Could change how you think about acquisitions.
We're looking at the practical details, the nuts and bolts, and the bigger implications laid out here.
Exactly.
All right, let's dive right in then. At its core, what does it mean to buy a property subject to?
Well, what's laid out in the material is pretty direct. Buying subject to, it means you, the buyer, you get the property, you take ownership, the deed gets transferred to your name or maybe your company.
Right.
But the absolutely critical piece is that the original mortgage loan, it just stays in the seller's name.
Stays with the seller.
Yeah. You, the buyer, agree to make the monthly payments on that existing loan. But, and this is key, you are not assuming the loan officially with the bank. You're not applying for new financing yourself.
Okay. So I own the house. I control it. I can rent it out as an STR. But the debt itself, the actual loan, is still technically tied to the person I bought it from.
That's it.
And I'm essentially just making the payments for them on their behalf.
Precisely. You get the asset and the control. They, on paper, still hold the liability, but you're the one servicing that debt obligation.
Give us the example from the material. Seeing the numbers always helps make it, concrete.
Sure. So imagine a house. Maybe it's worth $300,000. The seller still owes, let's say, $250,000 on a mortgage they got a few years back.
Right.
And they locked in a great rate, maybe 3% fixed. So the total monthly payment, principal, interest, taxes, insurance, the whole PITI is, say, $1,400.
Okay.
If you buy this property subject to, you take ownership, maybe you pay a small amount to the seller, could be just closing costs, maybe a little extra as an incentive.
Right.
And you simply step in and start making that $1,400 payment every month on their old loan.
Wow. That ability to just step into a payment structure like that, that's pretty powerful, especially when you think about today's interest rates, like 7%, 8%. So the massive initial benefit is you're acquiring ownership and control without having to qualify for a brand new $250,000 mortgage at those high current rates. And often you're doing it with way less cash up front compared to a typical 20% down payment.
That's the core of it. You completely sidestep the entire traditional bank underwriting process for the acquisition itself.
And the material points out who this is particularly good for, right?
Yeah, it really highlights STR operators. So if you want to avoid tying every single property purchase to your personal credit score through conventional loans. Or if you're really eyeing those older, super low interest rates, 3%, 4%, that just feel impossible to get today.
Yeah.
Or maybe your main goal is just to scale your STR portfolio faster without hitting those typical debt-to-income ratio ceilings that banks slap on you. This strategy offers a pretty clear alternative path.
That makes a ton of sense. Bypassing that whole qualification hurdle really opens things up.
Yeah.
But how do you actually do one of these deals? It sounds like it needs careful structuring.
Oh, absolutely.
Let's walk through the steps this material lays out. Step 1, the big one, is finding the right seller.
This is absolutely foundational, yeah. This strategy works best with sellers who are, motivated. Think about people who maybe have very little or even no equity.
Right. Not enough to sell traditionally after commissions and costs.
Exactly. Or people who are struggling to keep up with the payments, maybe even facing pre-foreclosure.
Okay.
Could be someone who inherited a property they just don't want the hassle of. Or, tired landlords, just burnt out, ready for a clean break.
And the reason these sellers are ideal, like the material says, is their main goal isn't necessarily squeezing every last penny out of the sale.
Right.
It's finding relief. Relief from the burden of the property, the mortgage payment.
Relief is the key driver.
Yeah.
And the practical tip given here is to focus your search on off-market leads. So things like pre-foreclosure lists, data on absentee owners, probate leads, maybe properties that were listed on the MLS but expired without selling. You're looking for situations where a standard sale isn't the best fit for the seller.
And the way you talk to them is crucial. The material frames it not like you're trying to lowball them.
No, definitely not.
But more like you're offering a solution to their specific problem. It even mentions this owner script idea, not like a literal script, but a way to approach the conversation.
Right, a framework. The purpose is to approach the seller with clarity and honesty. Positioning yourself as someone offering a creative solution, not just another buyer making an offer.
Makes sense.
You explain the subject to idea simply. Look, I'll take over ownership, I'll make all the mortgage payments on time, I'll cover all the property expenses, taxes, insurance, and I'll handle all the maintenance and repairs.
So you're painting a picture for them of a really clean break. No more mortgage stress, no more calls about leaky faucets, and it helps protect their credit.
Right.
Right, especially if they were falling behind. And the framework points out other benefits for them, too, like avoiding realtor commissions.
Big one.
Sidestepping all those bank delays, maybe getting out from under foreclosure pressure fast.
Right. It's all about showing them how you take on the burdens they want to get rid of. You provide that relief they're looking for.
Okay. So you've found a potentially motivated seller. You've had that initial conversation using that solution-focused approach. What's the next step in actually structuring the deal?
Okay, so the material walks us through putting together the purchase agreement. It's basically a standard real estate contract. But, and this is critical, it absolutely must include a special addendum.
An addendum?
Yes, specifically detailing the subject to terms. You can't just gloss over it.
And what are the essential points that need to be in that addendum, according to this?
Well, it needs to state very clearly that the buyer is taking title subject to the existing mortgage, number 1. The seller has to agree not to mess with the mortgage, like they can't go try and refinance it after you've taken over.
Gotcha.
The buyer, that's you, agrees to keep all the mortgage payments current. And, of course, the buyer takes responsibility for property taxes, insurance, and all the maintenance from the closing day forward.
Transparency and clarity here seem absolutely non-negotiable.
Totally, to protect everyone. And the material strongly, strongly advises using legal professionals, either an attorney who gets these deals or an investor-friendly title company that has experience with subject-to transactions. Get them to draft or at least review the documents.
That's critical advice. Don't DIY the legal stuff.
Oh.
Okay, so the agreement's being drafted. Next step seems to be getting all the nitty-gritty details about the actual loan you're about to start paying.
Right. You can't just take the seller's word for it or, rely on their last statement. You need the precise details.
Like what specifically?
The exact current loan balance, down to the penny, the precise monthly PITI amount, the type of loan, is it conventional, FHA, VA? That can matter.
Oh.
The status of the escrow account, if there is one. And getting access to the amortization schedule is helpful too.
And to actually verify all that directly with the lender, the seller needs to sign something specific. Doesn't disappear.
Yes, a really crucial document here is called the Authorization to Release Information Form.
Okay.
The seller signs this, and it gives you, or more likely the title company handling the closing, the legal permission needed to call up the seller's lender and get all those verified loan details straight from the horse's mouth. It's a key piece of due diligence. Can't skip it.
Understood. Makes sense. So you get the info, you draft the agreement, then it's time for step 4, actually closing the deal. How does that work without a traditional bank providing funding at closing?
You still close with a professional third party, usually a title company or a real estate attorney, just like a conventional sale, actually.
Right.
They manage the process, handle the paperwork, but they structure it specifically for the subject to transaction based on your agreement.
And their job is to prepare the new deed.
Yeah.
That's the document that legally transfers ownership to you, right?
Yep.
Like a warranty deed or maybe a trust deed.
Exactly. They prepare that deed. They also do the title search to make sure there aren't any other unknown liens or judgments against the property that could cause problems.
Right.
They handle title insurance, manage any funds changing hands, like your initial payment to the seller or closing costs, and just make sure the whole transfer is done correctly, legally, ethically, according to the purchase agreement.
Okay. And this is also where that idea of using a land trust might come in. The material mentions that as an option some investors use.
Yeah, it does. It's not required, but some investors choose to use one.
What's the thinking behind using a land trust in a subject-to deal? What's the strategy there?
Well, there are a few potential reasons mentioned. One is it can sometimes add a layer of separation or anonymity. Transferring title into a trust might be less obvious to the lender than transferring it directly into John Doe's name.
Ah, okay. Less likely to maybe trigger that due on sale clause we'll talk about later.
That's part of the thinking for some, yeah. Though it's not a foolproof guarantee, it can also make it simpler to transfer ownership later on, maybe into an LLC you set up. And for some people, especially STR operators dealing with guests, it offers a degree of identity protection or privacy. Maybe shields your personal name from public records associated with the property.
Interesting. Okay, so that's an option to consider. We're at the final step now in getting the structure really locked down, setting up how the payments actually get made and making sure the property is properly insured.
Yes, and these steps are absolutely vital for the success of the deal and also for doing it ethically, protecting both you and the seller. For payments, the material really emphasizes using a third-party loan servicing company.
Okay, so wait. Instead of me, the buyer, just sending a check to the seller each month or even paying the bank directly, there's an intermediary involved.
Exactly. You use a professional loan servicer. They collect your monthly payment, the $1,400 in our example, and they ensure it gets sent directly to the original lender, on time, every month.
Ah, I see. And the benefit of that?
Well, the material points out several. First, it builds crucial trust with the seller.
How so?
Because it provides accountability. The seller can often get statements or login access from the servicer confirming that, yes, the payments are being made. This gives them huge peace of mind, since remember, their credit is still technically tied to that loan.
Right. That makes sense. They can see it's happening.
Yeah. And it creates a clean, verifiable paper trail for everyone involved. No, he said, she said, about whether payments were made.
That transparency sounds huge for the seller's comfort level.
Okay.
And what about insurance?
You absolutely need a new landlord insurance policy, non-negotiable. And crucially, this policy must name you or your trust or your LLC, whoever holds the title, as the primary insured party.
Okay, that makes sense. I own it now.
And it must also name the original lender as an additional insured or mortgagee on the policy.
Why the lender?
So that if something bad happens, a fire, major damage, the lender's financial interest in the property is protected too. Their loan is secured by the house, after all. This keeps them happy and covers all bases.
Got it.
And you might also need to set up an escrow reserve with the loan servicer for property taxes and insurance if those weren't already bundled into the original PITI payment the seller was making.
Okay, wow. So we've defined it, gone through the steps to structure it properly, ethically. Let's zoom out a bit. What are the really big upsides and maybe the potential downsides of using this strategy, especially thinking about it for short-term rentals?
Okay, the advantages, particularly if you're looking to grow an STR portfolio, they're pretty compelling based on this material. We've touched on some, but let's just, reiterate. First big one, no traditional credit check required for the acquisition.
Huge.
You sidestep that whole qualification barrier. Second, you get to keep the low interest rate on the existing mortgage. That's a massive financial win compared to borrowing today.
Absolutely. Saves a ton on monthly payments.
Third, often you need little to no down payment. Maybe just enough cash to cover closing costs, perhaps a small payment for the seller's minimal equity, or just as a thank you.
Bunch less capital up front.
Fourth, you get instant ownership. The day you close, it's yours. You can start setting up, furnishing, and operating your STR almost immediately.
Start generating revenue faster.
Yeah.
And what about the ability to scale? That seems like a major point here.
It really is, because you're not applying for a new loan tied to your personal finances every single time you buy.
Right?
You're often not constrained by those traditional debt-to-income or DTI limits that banks impose.
The DTI trap.
Exactly. That freedom from the standard DTI calculations can significantly accelerate your ability to acquire multiple properties compared to going the conventional financing route for every single one.
But that scaling potential without the usual DTI handcuffs,
Yeah.
that's a pretty significant benefit for empire builders. But okay, there have to be risks, right? The big one everyone always talks about is the due on sale clause.
Right. You have to understand this one. Almost all conventional mortgages written in the last few decades have a due on sale clause. It's standard language.
And what does it mean exactly?
It means that if the property is sold or the title is transferred without the lender's explicit written permission, the lender has the contractual right to call the loan due, meaning they can demand the entire outstanding loan balance be paid back immediately, all $250,000 in our example.
Yikes. That sounds potentially catastrophic. Like a deal killer, if the lender finds out you did a subject to, they could just demand hundreds of thousands of dollars right away.
That is the theoretical risk, yes.
Right.
And you absolutely need to be aware of it. However, the material provides some really important context here.
Okay.
While the right exists in the contract, the clause is rarely enforced by lenders in practice.
Really? Why not?
Well, think about it from the lender's perspective. They typically just want to receive the monthly payments on the loan. As long as the loan is performing, meaning the payments are coming in on time, every month they usually don't have much incentive to rock the boat. Calling a perfectly performing loan due and potentially forcing a foreclosure process is complicated, costly, and generally not their preferred outcome unless there's a clear reason, like the loan going into default.
So the number one defense against triggering that due on sale clause is simply keeping the loan current, always paying on time no matter what.
Absolutely. Consistently making timely payments through that third-party servicer is the single best way to remain off the lender's radar and avoid giving them any reason to look closely or enforce the clause.
And you mentioned the land trust earlier. That's another potential mitigation tactic.
Yes, and as we discussed, using a land trust to hold the title is a strategy some investors employ. The idea is it may reduce the visibility of the ownership change to the lender compared to putting it directly in your personal name. It's not a guaranteed shield, but it's a layer some find useful.
Okay, what about the risk from the seller's perspective? Their name is still on that mortgage even though they don't own the house anymore.
This is the seller trust risk, and it's significant. If you, the buyer, fail to make those payments, it directly hits the seller's credit score.
Ouch.
And potentially leads to foreclosure proceedings initiated against a loan that's still officially in their name. That's a terrible outcome for them.
So how do you manage that risk for the seller?
This is precisely why using that third-party loan servicing company is so incredibly critical.
Back to the servicer.
Yes. It provides the seller with verifiable, independent proof that the payments are being made consistently. It builds confidence, provides accountability, and of course, establishing a really clear, fair, win-win agreement from the very beginning is key to fostering that initial and ongoing trust.
Makes sense. And finally, the material really hammers home the importance of handling all of this legally and ethically.
This point just cannot be overstated. You absolutely must be completely transparent with the seller about exactly how the transaction works, what the risks are for them, what the benefits are.
No pulling the wool over their eyes.
Absolutely not. Never mislead the seller, or the lender for that matter, about the nature of the agreement. And, as we've said a couple of times, always, always use licensed professionals, experienced attorneys, knowledgeable title companies. Get them to draft, review, and execute all the documentation correctly to ensure it's legal and protects everyone involved.
So done transparently and legally, it's a valid creative strategy.
Yes, but done improperly or unethically, it can lead to really significant legal and financial problems for everybody.
Okay, so this strategy clearly offers some massive advantages for getting into properties, scaling up, especially leveraging those great older interest rates. But what's the long game? You don't necessarily want that mortgage sitting in the seller's name forever, do you?
That's a great point, and that's where the advanced strategy element discussed in the material comes in. The idea isn't necessarily to leave it like that permanently.
Okay.
The subject to acquisition is often the first step. It gets you control of the asset quickly and lets you immediately start generating income with your short-term rental operation.
Right. Get the cash flow going.
Exactly. And as your STR becomes profitable, as you build up a solid financial track record for that specific property.
Then you can leverage that performance.
Precisely. The material points out that you can then use that positive operating history and the income generated to potentially refinance the property into your own name or your business entity's name down the road.
Ah, so you eventually get your own loan on it.
That's one path. Or if your STR profits are really strong, maybe market conditions are right, you could eventually choose to simply pay off the seller's original mortgage entirely. Just eliminate it.
Take them completely out of the picture.
Yep. Gain full, unencumbered control. The material also mentions the possibility of structuring maybe a future lease-to-own agreement or a planned sale agreement with the seller as a defined exit strategy for them down the line.
Okay, so it's not necessarily the permanent state of affairs. It's more like a powerful, creative way to acquire the asset, gain control fast, and then use the property's own performance to transition to more conventional ownership or complete payoff later on.
That's a great way to put it. You're using a creative acquisition method to get in the door, build a long-term asset, and then strategically work towards gaining full control over time.
Right. So bringing it all together, this subject-to approach, according to the material we've looked at, really provides a pathway for STR investors specifically to bypass a lot of those traditional financing headaches.
Yeah.
You can potentially tap into really favorable existing loan terms, those low interest rates, accelerate your portfolio growth,
Inch faster, potentially.
help out motivated sellers who are stuck,
Mm.
all while you're building equity and control over the property.
It really translates into potentially faster deals, needing less capital up front, getting that immediate potential for cash flow from starting the STR right away, and a lot more flexibility in how you structure your portfolio growth, kind of away from those traditional lender constraints like DTI.
But it's a big, but we keep coming back to, it absolutely depends on doing it the right way.
Absolutely.
With total transparency, solid legal documentation drafted by professionals, and using those crucial tools like third-party servicing to protect both yourself and the seller whose name is still on that loan.
Structure, ethics, and professional guidance are absolutely paramount. Can't cut corners there.
Okay, so here's maybe a final thought for you, the listener, to chew on, based on everything we've just unpacked. When you think about the potential to acquire properties using their existing, maybe super low interest rate mortgages, and the ability to scale your investments faster because you're not constantly hitting that DTI ceiling with banks, how might this subject to strategy fundamentally alter your long-term plan for building a real estate portfolio compared to relying solely on conventional bank financing?
It really offers a different way to think about getting started, doesn't it?